Now it's my pleasure to introduce you to Peter Frech. Peter Frech has a master's degree in psychology. So we have red chairs. We should have maybe red sofas. He has been joining in 2007 Quantex group. And since 2008, he has been an extremely successful value fund manager. Lucky for us competitors, he did a soft close. So he has been really very successful, and we are extremely happy to have you here, Peter and his colleague, Livio Arpagaus.
Yeah, thanks, Alex, for the kind introduction. So our case is Petrobras, but first a few words about Quantex. We are not, contrary to the results, we think of ourselves as not very smart or sophisticated value investors. We're looking for value at plain sight. We're not good at forecasting operating margins or tax rates in 2042. So we're really looking for a margin of safety and the obvious cases. So who are we? We're a small fund boutique founded in 2003. We have FINMA license since 2008. 5 fund strategies and about 2 billion AUM in total. Here you can see the team. Basically, the fund management of the value strategies is done by the 3 guys on the right side. So that's me, Livio Arpagaus, who's with me today, and Moritz Nebel. And how do we work? Basically, our investment process is very much quant-driven. So we try to get rid of all these behavioral biases where you always look at the same companies, the same sectors you feel comfortable about. We try to get rid of that by doing quant screenings to generate ideas. So we do global quantitative screenings all the time using Bloomberg, but also empirical research, which is an external research provider. And they generate ideas for us. And we're basically screening for cheap stocks, mainly based on free cash flow yields. And then we do a very short quality check. So we don't dig very deeply. We don't do site visits. We don't talk to management. It's just a rather short quality check. And the main question here is, why is the stock so cheap? Because we're screening for dirt cheap stocks, and we try to understand why is it cheap. And the main question is it a temporary problem, a solvable problem, maybe a cyclical downturn, maybe there's an image problem. Now a lot of companies have image problems for ESG reasons, for example, but there are also country discounts, British stocks after Brexit, etc. These kind of image problems we like. What we try to avoid is companies that are cheap because they have a potentially deadly problem. Secular decline stories, over-leveraged companies, especially over-leveraged cyclicals. These we try to avoid. So we're happy to buy into cheap stocks, but we try to avoid the potentially deadly value traps. And we also look at capital allocation because we screen for free cash flow. We want to know what management is doing with our free cash flow. And we like it to get it back because usually management over time they tend to do empire building and doing a lot of crazy stuff. So we prefer a high cashback yield. Then we do a rough valuation, not very sophisticated fair value estimates, discounted cash flow, but really very, very, very rough and basic. And out of that, we build a portfolio of about 40 names. So it's rather concentrated. And what's special here is we equal weight them as well. We don't want to have any favorites in our portfolio. I think that's psychologically dangerous if you have favorites, big overweight positions. So we do the equal weighting, and we also do the rebalancing to keep the equal weights. And how we look at risk or our strategy or philosophy in general is this winning by not losing approach. So we basically see 2 risk dimensions. One is kind of operating leverage, how stable or unstable are the cash flows, free cash flows of a company. And the other dimension is financial leverage, basically the cash flow obligations coming from the balance sheet. And by doing these 2 dimensions, you get 4 quadrants. And basically we say there's one quadrant, we call it the death zone, the red quadrant, the upper right quadrant of companies that have unstable, cyclical or declining free cash flows and a lot of financial leverage. And we don't want to invest there at any price. And that's a difference to other value strategies that say, yeah, well, if it's cheap enough, we buy anything. We say, no, if there's a serious risk, potentially deadly problem, company might go out of business in a recession, in a credit crunch, in another COVID lockdown, whatever, then we don't want to touch it. That doesn't mean that you can't make a lot of money in the death zone. I think a lot of value investors can make a lot of money, but you can also easily blow your brain out there. I think it's really tough. You have to be good at timing. It's emotionally, psychologically stressful to be active there. You can make a lot of mistakes, especially when it counts the most. So we try to avoid it and focus on the other quadrants, cyclical companies with no leverage or leverage companies with stable free cash flows like tobacco companies. So coming to our case study, Petrobras. Just as an introduction, it's one of the largest oil producers, producing about 2.6 million barrels of oil equivalent today. It's mostly oil, not much gas. Oil is produced in Brazil, mostly offshore in these relatively new pre-salt discoveries. And the Republic of Brazil controls 50.3% of the votes, not of the capital, but of the votes. We own, like most other investors, we own the preference shares that have no voting power. So valuation, I think that's really value plain sight. Free cash flow yield on enterprise value, that's current Bloomberg numbers, 36%. Free cash flow yield on equity, it's 55%. Dividend yield is 48%. So not only there's a big free cash flow, you also get it all back as a dividend, or even a bit more of that. And so it's really dirt cheap. There's a huge margin of safety, and yeah, that's basically it. Any questions? No, obviously there are always some questions, so I try to answer some of those. Why is it so cheap? I think that's kind of the quality check. It's obviously dirt cheap, but why is it so cheap? So we think there are potentially 4 reasons: bias against Brazil, maybe financial leverage, maybe oil cyclicality, maybe corruption and political risks. So bias against Brazil, you can clearly see that if you look at some current numbers. For example, in red you see current inflation rates around the globe, and you see Brazil actually has a lower inflation rate than the US, the EU, UK. It's been the case for the last 2 years. They always had a lower inflation rate than the major Western countries. And despite that they have a way higher interest rate, central bank rate. So you get very high real yields in Brazil. And on the other side, you get very negative real yields in other countries. And also, overall, government debt to GDP looks way better in Brazil. They have way less debt than other Western countries. They have way better demographics as well. So we would argue that Brazil has very sound finances, but is suffering from a kind of an image discount. And you also see that if you compare Petrobras to other oil majors, which are more or less of the same size. You can see here, last year, Petrobras generated about $40 billion of free cash flow. It's more or less the same as Chevron and Shell produced. But the enterprise value and also the market cap of Petrobras is just 1/3 of the others. So there's a huge valuation discount despite having a very profitable company. Now maybe there's a risk with regard to financial leverage, but there isn't. There maybe was one a few years ago. You can see here the green bars are the net debt position, including financial lease obligations, and you see almost 10 years ago they had over $100 billion of net debt, so that was a concern, but that has been massively deleveraged. It's now down to 40 billion and change, and net debt to EBITDA ratio at 0.7 is very low. And also the debt maturities, weighted average maturity is 10.7 years. So I think there's no financial risk at all here involved. Now maybe it's the cyclical risk that keeps the stock cheap. Is it more cyclical than others? No, it isn't. The actual production or lifting costs of its oil barrels are very low. these offshore oil fields, they have very high initial capex requirements, but once you get the fields pumping, you have very low extraction costs. It's just $5.50 per barrel. On top of that, you get taxes, etc., and then DNA, obviously, the government's take. So all in, you get to about $33 per barrel. But if oil prices were to fall, obviously, government takes will also go down. So even if we get into recession, oil price drops to $30 or maybe even $20 for a while, I think that wouldn't kill Petrobras. So there's no deadly risk for the company coming from oil cyclicality. Then maybe it's corruption risks. Well, that's a serious concern. Petrobras was the victim of a big political corruption scandal a few years ago during the offshore boom. A lot of money was paid as kickbacks from Petrobras to newly founded Brazilian companies to do all the offshore servicing and exploration, etc. And this led to a huge scandal, and a lot of politicians were involved and also convicted, including the current president, Lula da Silva. He was convicted for this corruption in 2017, but actually the trial was nullified in 21 for procedural reasons. So yeah, there was a serious case of corruption in the past, the big kickback scheme going. But the question is, will they really try to do this twice and hope to get lucky twice and not land in jail, especially now that everyone is closely watching their moves? And also consider that Lula's party in Brazil is just holding about a quarter of the seats in parliament, so they don't have a majority. It's a more or less evenly split country with regard to political sides or partisanship. So they're closely watching whatever they're doing, and also the regulators, the jurisdictions, etc. I think they will closely watch what they're doing. So I think there's maybe some corruption risk, but I don't think that it will kill the company. It didn't kill it the last time, and I think this time it's even way more unlikely that something like this will happen. Lately, there's another discussion coming up with regard to, maybe the president is trying to get Petrobras to lower fuel prices, gasoline prices in Brazil for the Brazilians. That may be an issue because they control the board due to their voting power. But on the other side, the board members still have a legal obligation to look for the interests of shareholders, so they just can't give away the gasoline for free. I think that would not be according to their legal obligations as board members. So I think the risk there is also not that big. There might be some token political changes coming, but I think it won't kill the company. So overall, conclusion, I think the discount really seems mostly to be based on image problems, mainly due to ESG. Everyone hates oil companies. And then Brazilian politics, there's a big discount on emerging market companies in general, and maybe Brazil in particular. But I think that's the main reason for the big discount. I don't see others. There's some risk of future capex misallocations, obviously, maybe with regard to corruption, but also with regard to ESG investing. Yeah, they're trying to force Petrobras to invest more in solar and wind offshore production. They probably waste $1 billion or $2 billion or maybe $5 billion, I don't know. But with 40 billions of free cash flow and 40% free cash flow yields, you can afford to do that. It's still a lot of margin of safety in the valuation. And we also like the very high dividend distribution as a protection against that. As long as we get these very high dividends, we're not that concerned. If they were to cut the dividend massively and start ramping up capex for whatever reasons, then we would have to rethink our position. But for the time being, we're very happy with the place the company is at. So we think there's a very, very high margin of safety. And just as to end the presentation, a few words about our fund, the Quantex Global Value Fund, which is currently soft closed. So there's a cap on the amount of shares outstanding, but some shares are free at the moment, so you can still buy some if you like to. And here you see the long-term performance of our fund in black and the MSCI World in red and the MSCI Value Index in green. And obviously there was this huge outperformance run over the last 2 or 3 years that looks impressive because of the scale, but that was rather easy. We had a lot of tailwinds as value investors. I think we're more proud of our achievements the 10 years before that, when it was very, very hard for value strategies. You see that the green line was way below the MSCI World Index to beat the index. And we were one of the very few value funds that managed to beat it. So, and the secret to our success was probably not the stock selection in the sense that we picked the best winners or anything like that, but that we avoided the worst losers. So we screened for cheap stocks, but avoided the death traps, the deadly value traps. And by doing that, we generated the outperformance. So that's my presentation. Thanks for your attention, and I'm open for any questions you might have.
Thanks a lot, Peter. And I must say that, Peter is a very humble person, because I think if you look at the track record, is among the top in the world. There is Fundsmith out there with managing 24 billion, still open for subscription, but Peter and Livio are beating these guys. But these guys are closed or soft closed, which I think shows a lot also on the personality. Now, I think there are for sure some questions, and I'm pretty sure that everybody of you over the mobile phone, over the Charles Schwab trading account, bought already Petrobras shares during his presentation. Yeah. We own Petrobras as well.
Just a friendly reminder why you should buy it.
We own Petrobras as well for our Natural Resources Fund. There is a question here.
Thank you, Peter. First of all, congratulations to your success. I know you for quite a few years now. And you said before that you managed to avoid the value traps. And that's a very hard thing to do. How did you do that?
Yeah, well, we still get into a lot of value traps. Obviously, that comes with our approach. But yeah, I think we can avoid some of the worst. This death zone companies where you have this risk of a permanent loss of capital. And that's kind of the trick. Everyone is trying to beat the market by looking for the biggest winners, the next Microsoft, the next Amazon, whatever, to generate outperformance. And we say, no, it's far easier actually to avoid the worst stocks than to find the best stocks. So if you buy reasonably cheap companies with more or less sound balance sheets, then you should do okay over time if you can avoid some of the worst value traps.
We can maybe have one more question, maybe at the very back. Because Peter's going to stay here.
Yes, I'm still here for lunch.
Could I don't know whether it's public knowledge, but could you tell us what percentage of the shares are held by you and the management?
In Petrobras, huh?
In Petrobras, or
not in Petrobras?
in the fund.
Your fund. Yes.
Oh well, it's a rather low share now because the fund has become so big. Obviously, there's no performance fees, so there's not some kind of carried interest scheme going on. It's all the shares we bought with our own money over time. But all of the team have a significant amount of their personal wealth invested into the fund.
Thanks a lot. Peter is still here for further questions, and I think we will go now for the last presentation.